Welcome back to Investing Talk Podcast.
Today we're looking at applied digital. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Applied digital, ticker APLD, they've really, grabbed attention as a key first mover in high-performance computing, or HPC infrastructure.
Right, and they're not just building standard data centers, are they? It's more specialized.
Exactly. Think highly specialized facilities, really tailored for the huge power needs of AI, machine learning, and even some blockchain stuff. They're kind of selling the shovels in this AI gold rush.
Selling the shovels, yeah. But are those shovels making money yet? That seems to be the core question.
That's the tension, definitely. We need to unpack that. If you look at the reports after their Q1 fiscal 26 earnings back in October, the growth projections alone are pretty staggering. Suggests they're already winning big contracts.
Okay, let's talk numbers then. Where did they start and where are they headed according to these forecasts?
Right. So for the full fiscal year 2025, Applied digital reported revenue of about $144 million. That's our baseline.
Okay, $144 million. And the forecast for this fiscal year, FY 2026.
It's projected to, explode. More than double, actually. They're targeting around $310 million. That's a 115% year-over-year jump.
Wow, 115%. And it doesn't stop there, does it?
Nope. Analysts see that hypergrowth continuing into fiscal 27. The projection there is over $500 million, maybe $523 million.
Incredible numbers. But okay, here's the catch, right? This is still a growth company, spending a lot.
That's the crucial context, absolutely. High growth, but also high spending. They are not profitable yet. Looking at the trailing 12 months, the net loss is around $248 million. Negative EPS, too, about minus $1.09.
Hold on. Losing almost $250 million, but the analyst consensus is strong by. How does that work? Seems like a contradiction.
It does, but that's the growth stock playbook, isn't it? Analysts aren't judging them on today's profit. They're looking at how quickly those losses are shrinking and, maybe more importantly, the quality of the future revenue they've already locked in.
So the Q1 report was key there, beating expectations.
Exactly. They beat revenue estimates by over $14 million. That showed Wall Street, look, our operations are starting to ramp faster than our spending. The bet is that all this current investment, the CapEx, will soon turn into high-margin, sticky revenue from those huge contracts.
Okay, so the big money, the institutions, they seem convinced APLD has built a real competitive advantage, a moat. In data centers, it's about scale and locking in customers long-term, right?
You nailed it. And their contracts, they look incredibly solid. Two huge ones really stand out. First, that partnership with CoreWeave.
The AI company.
That's the one. That deal alone is worth potentially $11 billion over multiple years for AI data center hosting. This isn't just hope for income. It's a massive backlog commitment.
$11 billion. That's a number that definitely grabs your attention.
Yeah.
But you mentioned specialization, too. Things like cooling technology. Why is that such a big deal for investors to understand?
Oh, it's fundamental to their edge and to profitability. See, standard data centers aren't built for the kind of heat these AI chips, these GPUs, throw off when running full tilt.
Right, they get incredibly hot.
Immensely. If you can't cool them efficiently, you either have to slow down the computing power or your energy costs go through the roof. Applied Digital's proprietary cooling tech lets them handle these intense HPC workloads effectively and, crucially, cost-effectively. That's a big reason CoreWeave chose them. They deliver something others struggle with at this scale. It's a real barrier to entry.
Makes sense. That specialized capability then leads us to the other huge piece of news from October, right? That massive lease.
Yes. This one is potentially game-changing in terms of de-risking the company, even with the stock's volatility. They announced a roughly $5 billion lease agreement over 15 years.
15 years. That's incredibly long for a tech-related contract. It really is. Provides amazing revenue visibility. And the client, identified as a major U.S. investment-grade hyperscaler. Investment-grade, that's key, isn't it? Means they're very likely to pay their bills.
Absolutely. It gives that revenue stream a kind of utility-like reliability. This lease is for their Polaris Forge 2 campus up in North Dakota, covers 200 megawatts of capacity initially.
Okay, 200 megawatts, $5 billion over 15 years. That's solid.
But wait, there's more. The deal also includes a right of refusal for another 800 megawatts of capacity at that same site.
Wow, so they've locked in $5 billion with the potential for 4 times that amount from the same top-tier client. Okay, now I see why they got that Best Data Center in the Americas award. They're delivering the specialized scale the big players need.
That seems to be the story. Okay, so we've established the fundamentals, the financials, the contracts look, well, exceptionally strong on paper. But does the stock chart, the technical picture, agree?
Let's look at that. The momentum is pretty undeniable, isn't it? The stock went from a 52-week low, under $4, what was it, $3.31
No,
center,
around there.
to a high of over $40. That's a huge, huge move.
It shows just how quickly the market bought into this AI infrastructure story. And technically, yeah, it's trading well above its 50-day and 200-day moving averages. That's like textbook uptrend stuff. Momentum is clearly with them.
There's always a but, especially here. We absolutely have to talk about the volatility. It's extreme.
It is. This is the elephant in the room, and you really need to understand this if you're considering the stock. Applied Digital has a beta of 6.59. That's exceptionally high.
Okay, break that down. Beta 6.59, what does that mean in plain English for an investor?
It means the stock is theoretically expected to be over 6 times more volatile than the overall market, say the S&P 500. So if the market hiccups and drops 1%, APLD could easily drop 6% or more, and vice versa on the way up.
So massive swings are just part of the deal here. It's super sensitive to any market jitters or sector sell-offs. Definitely not for the faint of heart.
Not at all. High risk, potentially high reward. That's the profile.
Which means knowing the key technical levels is critical for managing that risk. Where are we seeing support and resistance now?
Well, after the recent earnings, support seems to have firmed up around the $30 mark. If it holds there, that suggests the bigger players, the institutions, are buying the dips. Resistance is hovering around that recent high near $40.
And the trading volume has been high.
Very high, especially after earnings. That generally suggests institutions are accumulating shares, which can help stabilize things a bit, despite that crazy beta.
Okay, let's shift gears to the near future. For anyone holding or thinking of buying this volatile stock, what are the key things to watch for, the catalysts in, say, the next 3 months?
The most immediate one is the next earnings report. That's expected around January 2026. This will be the first quarter really starting to show the impact of ramping up those huge new contracts. The market wants to see continued strong year-over-year growth.
Makes sense. And the physical build-out itself is a catalyst, right? Getting those data centers online.
Absolutely. The Polaris Forge 2 expansion is happening now. Any news on hitting construction milestones or when that new capacity officially comes online and starts generating revenue from those big leases, that's a major catalyst. Every megawatt switched on is money in the bank.
And updates on the CoreWeave deal, that $11 billion behemoth.
Yeah, keep an eye on that too. It's a long-term deal, so any updates on hitting specific deployment phases, activating more capacity, or even further commitments from CoreWeave could definitely move the needle.
Beyond the confirmed stuff, what about rumors or speculation?
Well, there's always chatter. Given they have that right of refusal for 800 more megawatts with the hyperscaler, rumors about more deals like that are persistent. Seems plausible, right?
It does. And what about strategic moves? Expansion, acquisitions?
That's another area of speculation. Could they look internationally? Could they make acquisitions to grow faster? In this AI infrastructure race, speed is critical, so M&A isn't out of the question for a company scaling this quickly.
But underneath all that, the big picture driver is still just the massive ongoing demand for AI infrastructure, isn't it?
That's the structural tailwind. That demand should support growth through 2026, 2027, almost regardless of the short-term news cycle. Assuming the AI boom continues, of course.
We've painted a pretty bullish picture driven by contracts and growth, but we need balance. Let's clearly lay out the risks. What could go wrong here?
Absolutely essential, especially with that beta. First, company-specific risk. They're still losing money. If access to capital tightens or if they miss those ambitious growth targets, a high beta stock like this can get hammered. The market's pricing in near perfect execution.
And execution risk itself is huge when you're building massive infrastructure projects. Delays must be a major concern.
Critical concern. Delays in building the data centers, maybe supply chain problems, permits, whatever. Or if clients are slow to ramp up their usage on these big leases, that directly hits revenue and could really shake investor confidence. These contracts likely have timelines and performance clauses. Miss those, and it's not just delayed income, it could mean penalties.
Yeah, and then there are sector risks. Even though they're focused on AI, they have ties elsewhere.
Yeah, two main things. One, some lingering exposure to crypto volatility from earlier business, though that seems less central now. More importantly, they are highly dependent on this current AI boom continuing at pace. If AI investment slows or the type of computing needed changes, that could impact future demand and lease rates. even for their specialized centers. That's the core macro risk dependence on sustained exponential AI growth.
Okay, so hypergrowth, massive contracts, first mover advantage versus significant execution risk, ongoing losses, and extreme volatility. Let's bring it all together. What's the final take
Yeah.
based on everything we've discussed?
Looking at all the factors, the consensus view remains strongly bullish. I'd rate it maybe a 9 out of 10 in terms of conviction based on the source
A
material.
9 out of 10.
Yeah.
Why so high,
Hmm.
despite those very real risks we just outlined?
Because Applied Digital seems positioned right at the heart of this massive AI infrastructure build-out. You have that explosive revenue growth forecast over 115% for this fiscal year. And crucially, you have those huge long-term commitments locked in the $5 billion lease, the $11 billion Corp deal. That gives them revenue visibility that's almost unheard of in tech. They're a unique pure play on essential AI infrastructure.
So how should investors think about this? Is it short-term trade on the catalysts or long-term hold on the AI theme?
I think the case can be made for both, actually. For traders, you've got clear near-term catalysts. The January earnings, news on the facility ramps, CoreWeave updates, those could create opportunities. For long-term investors, it's a chance to ride the multi-year AI expansion wave, banking on those big partnerships and the company scaling its capacity successfully over the next few years. While Applied Digital has successfully secured unprecedented multi-billion-dollar commitments that anchor its future, the success of this investment hinges entirely on the company's ability to seamlessly execute on these massive construction and capacity ramp-up projects over the next 12 to 24 months.